Hello fellow compounders. Do you know how much money you need to be able to live off your investments? What's that magic number that gives you the freedom to not have to work for money anymore? You should be very careful when calculating this number. It's probably the most important number you'll ever calculate in your life. In this video, I'll show you how to do it. Also, at the end of the video, I'll give you free access to the Excel spreadsheet I've used to run the scenarios for this video. Welcome to the Always Be Compounding Club, where we share ideas on how to build, grow, and enjoy wealth. I'm your host, Dennis Chen. I'm a full-time investor, entrepreneur, financial book author, Wharton MBA, and CFA charter holder. Welcome aboard. Let's get started. The amount of money you'll need to be able to stop working for money is easy to calculate. We'll call this amount your financial freedom number from now on. So here's the formula. The financial freedom number is equal to the annual expenses divided by the withdrawal rate. The two numbers are financial expenses, which is the amount that you'll need to live on every year, and two, the withdrawal rate. That is the percent of your retirement portfolio that you'll be using each year. Seems very easy, right? Well, it is not as straightforward as it seems. We can easily estimate our annual expenses. That's no problem. However, the withdrawal rate is more challenging to calculate. Most of you probably have heard of the 4% rule that was suggested in the Journal of Financial Planning in 1994 in an article written by William Bengen, a financial planner. The rule says that you can withdraw 4% of your retirement portfolio the first year, and in the following years adjust that amount by inflation. And you can be fairly confident that you won't outlive your money. That means you won't run out of money before you die. So if you're comfortable with that, we're done, right? The video's over, that's all. Hold it right there. Don't stop the video. That 4% might work for you, but it doesn't work for me. If you read the Bengen's article, his recommendation was based on historical data. And even though we might believe that the market will continue to average 10% of nominal returns, the sequence of those returns will most likely not repeat exactly. And the sequence matters. This is very important. It is not the same to start retirement in a year when the market is down 20% versus a year when the market is up 20%. I'll show you by using a simple example. But before doing that, let me point out three factors that will impact your withdrawal rate. Number one, duration, which is how long you will be living off your retirement portfolio. That's the amount of time between your retirement date and the day you expire. So unless you know exactly the day that you're going to die, this number will be your best guess. Our risk here is that we might outlive our retirement funds. This is what we call longevity risk. Factor number two, return on investment. This is how much will your portfolio be earning. This hits your withdrawal rate. This is obviously an important factor. If your return is, say, a consistent 7%, then a withdrawal rate of 4% is okay. However, if you can't be consistent on your returns, the 4% might or might not cut it. It might not last you the duration that you need. Factor number three, the volatility of returns. It is not the same, as I mentioned, to earn 10% consistently over 30 years than an average of 10% with some volatility thrown in between. So let's say you have a standard deviation of 15%. This is where the sequence of returns matters. Now let's go to an example to show you why the sequence matters. Let's review three portfolios that all have an average of 10% return over 3 years. So if we look at portfolio A, you can see that year 1, year 2, and year 3 are 10% returns, and at the end of 3 years, if you started with $100, you'll have $133.10. In portfolio B, the sequence starts with a loss of 15%, then gains 34% in year 2 and gains 16% in year 3 for an average of 10% per year, which also, if you started in $100, you end up with $133 $1.11, very close to the other one. And in portfolio C, instead of starting with a loss, you start with a gain of 34%, then you have a loss of 10% in year 2, and then you have a 10% win in year 3, also averaging 10%, giving you the same result as portfolio B's and portfolio A. Notice that all 3 portfolios produce the same 10% return on average with different annual returns. Does this matter? Of course it matters. Here's what happens if we take a 4% withdrawal rate or $4 every year from all 3 portfolios. So we have portfolio A, we take out $4 each year, and we end up with $119.86. Okay, starting out with $100 a year. If we do the same in portfolio B, we end up with $118.19, which is a difference of $1.67 versus portfolio A. And if we look at portfolio C, which actually starts with a positive return the first year, we end up with $120.73 at year 3. All 3 portfolios averaged the 10%, but portfolio C ended up with 87 cents more than portfolio A. So the sequence of returns could give you different outcomes over the long period of time. So this shows you that even though all 3 portfolios made the average 10% return, your outcome is different because of the sequence. So the sequence of returns could give you very different outcomes over a long period of time. This was just a 3-year example. Over 30 years, there's a lot of different probable sequences that can get you to the same return average, but different outcomes at the end of 30 years. The 4% rule that Bengen suggested was based only on one historical sequence. So if you use that number, be aware that it was only a one historical sequence that happened. Do you think that history will repeat exactly the same sequence, 30-year sequence? I don't know. So how do we overcome this analysis shortcoming? How do we get comfortable with the number we'll use for the withdrawal rate? The answer is we run Monte Carlo simulations. Here's an example of how we run the simulation. This is an Excel spreadsheet that I set up to run 5,000 iterations of the simulation. Let me just do one iteration so you understand. Here's initial investment level of $1 million. We're using a 7% average real rate of return for the S&P 500. We're using real rate so we don't have to deal with inflation. Basically, we assume that the rate was a 10% nominal rate of return, the average for the S&P 500. We take out 3% average inflation. That's how we get the 7%. The standard deviation historical is around 15%. In this scenario, we're using a 30-year withdrawal period and a withdrawal rate of 2%. Let's do a 4% withdrawal rate, which is what Bengen suggested. So I'm going to hit F9 to recalculate, and this is what we come up. Out of 5,000 simulations, up to 90% probability, you end up with at least $106,000. There's a 5% chance that you'll end up negative. Basically, you don't have money. So anything below that's red is no good. So in this case, at a 4% withdrawal rate over 30 years, you have a 90% confidence level that you won't end up broke before you die. You can change the number to 40 years and see what happens. Let's recalculate. So in this case, 85% chance that you'll be okay at the 40-year level with a 4% withdrawal rate. Let's build a scenario for defensive Daniel, whom we mentioned in our previous video. If you recall, Daniel invests all his funds in VOO, which is the S&P 500 ETF, and he would like to retire at age 55. The life expectancy in the United States is around 80 years. Let's say that by the time Daniel retires, it might be a little bit higher. So we'll use a life expectancy of 85. This gives him 30 years to live off his retirement portfolio. We'll also assume the real rate of return of 7%, which means after inflation, which is the historical average of the S&P 500, and also use the historical standard deviation of 15%. We'll run Monte Carlo simulations of 5,000 different probable scenarios. This means that 5,000 return sequences of 30 years that each average 7% return. That's 5,000 possible futures. And we'll look at the statistics and see what comes up. So the question we pose is, how many of those futures provide us with a portfolio that is positive at the end of 30 years? Which means that defensive Daniel doesn't run out of money. So if we look at this summary table that we have here, the top one, where we use the duration of 30 years, let's assume that we use $1 million as the investment level, a 7% annual return real rate for the S&P 500, as 15% standard deviation, and a duration of 30 years. Using this table, the question to answer is what withdrawal rate we can live with. We can see that at 2% withdrawal rate, we're fine. There's a 99% confidence level that in 30 years, the portfolio will end up with at least $161,000. So 2% we know is a very safe withdrawal rate at the 30-year level. At 4% withdrawal rate, which is this column over here, there's a 90% confidence level that you'll be positive, that you'll end up with at least $138,000 or more, based on 5,000 simulations. This means that 10% of the times, the portfolio will end a negative situation. So that's not good. Of course, the other variables are how much money you need to live and how much money you'll have to invest. Obviously, that will alter the decision on what withdrawal rate you'll decide to use. So, if Daniel needs $50,000 to live on, okay, that means that he'll need to use a withdrawal rate of 5%. 5% of $1 million is 50,000. That would give him an 80% chance of not running out of money. Or the inverse is a 20% chance that he will run out of money before he ends his retirement period. So can he live with that risk? Of course, there are alternatives. He could try to delay retirement and increase the size of the retirement portfolio. He could reduce his expenses or try to increase the return on investment. So what about enterprising Elizabeth, who was planning to retire at the age of 50? She would probably use a 40-year retirement period. Let's use this table in the middle, 40 years. This is what the 40-year table look like. 2% is still very safe, 99% level confidence that you'll end up positive after 40 years. At 3%, there's a 95% confidence level that you'll be positive, okay? And at 4%, there's an 85% confidence level that you'll be positive. However, when you get to 4.5%, there's over a 20% chance that she'll outlive her portfolio. So what happens if you decide to retire at 40 and expect to live until 90? That means that you need 50 years. So that's this table down here. Okay, at a 2% withdrawal rate, it still gives you a 97% chance of ending up okay. While at a 4% level, you'll only have an 80% chance of being okay. Anything above that, it doesn't work. Well, you have less probability of ending up with money. The withdrawal rate you'll use for your estimate of your financial freedom number will depend on your comfort level with the three factors, which are the duration, rate of return, and volatility. Personally, I am conservative and I'll be using a duration of 40 years, a 7% real rate of return of the S&P 500, and a volatility of the S&P 500 at 15%, which is a historical level. Even though I believe that I could probably do better returns in the S&P 500. Also, I am comfortable with the 95% confidence level that I won't run out of money. So that means by looking at the table, my withdrawal rate number is 3%. What's your rate? Let me know in the comments below. What is the withdrawal rate that you will be using for your financial freedom number calculation? So let's get back to calculating the financial freedom number. Let's say that defensive Daniel estimates that his annual expenses will be $100,000 a year, and he would like to be at the 95% confident that his money will last him 30 years. This puts him at a 3.5% withdrawal rate level. Therefore, we plug in the numbers, and financial freedom numbers for Daniel is 100,000 divided by 3.5%, which gives him a $2.86 million financial freedom number. He needs $2.86 million to be financially independent and live off his portfolio. Now let's get back to Elizabeth's financial freedom number. She would like to retire with an annual budget of $120,000, and she believes that she'll need her money to last 40 years. She's comfortable with a 95% confidence level. This puts her safe withdrawal rate at 3%. Therefore, her financial freedom number is $120,000 divided by 3%, which is equal to $4 million. You can use the tables to calculate your withdrawal rate and get to your financial freedom number. Also, as promised, you can download the Excel spreadsheet and run your own simulations. Just visit our website, alwaysbecompounding.club, register for free, and download the Excel spreadsheet with the Monte Carlo simulations. If this video was useful and you'd like me to continue doing more of them, subscribe and hit the like button. Thank you for watching, and remember to always be compounding. Have a great day. Take care.